Hi folks, and welcome back to Meaningful Money. Beautiful spot here just above Sennen Cove. Beautiful Saturday morning. Got to take advantage and get out here and film. Sorry about the handheld microphone. My little tie mic's playing up this morning, so I've got to look into that. But I'm sure you should still be able to hear me, at least according to the level meters on here. I hope, by the way, that you enjoyed the Money Vision Song Contest, episode 281, the last one. So check that out if you haven't seen it already. But back to reality now, and we're talking about asset classes, the things which make up a decent balanced portfolio. We talked 2 videos ago about cash, and now we're going to talk about gilts. But before we do that, I must thank my friends down here in the bottom right. That's 7 Investment Management, who continue to sponsor me here, for which I'm really, really grateful. Now, this is an update of episode 29, one of the really early ones, updating it really for audio and video quality purposes, but essentially the information is the same. Now, gilts are sometimes called, well, they are government bonds. And the problem with the word bond is it means about 6 different things in financial services. But for the purposes of this is actually the true meaning of the word, really. A bond is an IOU. So if the government, and when we're talking about gilts, we're talking about the UK government, if the government wants to borrow money, they might issue these gilts. And all a gilt is, really, is an IOU. So let me just bring in a piece of a graphic here, which is a piece of paper, which is essentially what you get when you've got a gilt. And on that piece of paper are 3 pieces of information. One is the amount of money that the government has borrowed from me. So let's call that £100. Secondly, the date that they're going to pay me that £100 back. And let's just call that 10 years from now, 2023. And the third bit of information is what we call the coupon, but which is more usefully called the interest rate. Sorry, I'm in a very public place here, so forgive me if I look around a bit and just make sure I'm not disturbing anybody. So 3 bits of information. It's really important to know that those bits of information are fixed. They are immovable. But what gilts are really all about is the income. That little 10% up there in the top left-hand corner. So as you can see, I've made the numbers quite easy here. So they owe me £100. They're going to pay it back in 10 years' time, and they're going to give me 10% in the meantime. Now, 10% is fairly helpful, but when it's 10% of £100, can you see that that is £10 per year in income? And that's what this piece of paper is all about, that £10 a year in income. Now, if it was that easy, it'd be simple and I could end this video now. The government in 2023 pay me my money back. They've had the use of my money in the meantime. I've had the interest. Everyone's happy. But gilts, like many things, are traded on the stock market. So it's time to bring in a third party. And this third party is going to be a pension manager. And he wants to secure £10 a year of income for one of his pensioners. And so he approaches me to buy my gilt off me, which, remember, is worth £10 a year. And he says, I'd like to pay you £200 for that piece of paper. And I say, yeah, nice one. I've just made 100% on the profit. So I no longer have my gilt. He's got it. And the government now owes him £100 in 2023. Now, you know, nobody'd ever pay 200 quid for something only worth £100. That's a silly example just to make a point, really. But he has paid over the odds because it's all about the income. He wants to secure that income for the next 10 years for one of his pensioners. But if in buying it for £200, he's going, first of all, he's reduced the yield notionally on it. Because that thing is only worth £10 a year, but he's paid 200 quid for it, that's a 5% interest rate now. And so that sort of reduced figure, if you like, is called the running yield. It's the income paid divided into the price paid for the gilt. But there's another factor. Because he's paid over the odds, in 2023 he's going to lose £100, isn't he? Because the government now owe him, and they're only going to pay him back £100 because that's the fixed amount on the piece of paper. And so he is going to lose £100 because he paid me £200 for it. And bringing in that capital loss into the equation gives you something called the redemption yield, and that's a really important figure if you're buying and selling gilts. Probably not something you'll ever need to worry about, because like most people, you'll probably hold gilts in a fund. Maybe not, but probably. And so that's a redemption yield, and these are 2 really important figures. And so that essentially is gilts in a nutshell. They are pieces of paper, they're IOUs, but they are traded on the stock market. They behave differently to things like shares. They are a lot less volatile. They're deemed to be extremely safe because the UK government is issuing them, and the chances of the UK government defaulting on a loan is pretty slim. Might be different if it was one of the European countries that are suffering at the moment. And so they're deemed to be safe. They behave differently to shares, and that's why it's a good idea to hold them in a portfolio. So that's Gilts. Leave any questions under the video here as ever. Next time I'm going to talk about corporate bonds, which are closely related cousins to Gilts. So thanks for watching this one, and I'll see you next time.